Analysts say the markets are yet to revisit their stance over the impending review of Moody's credit rating over South Africa. Moody's recently decided to hold back its rating announcement on South Africa, leaving the markets in suspense. The rating agency, however, left the rating at Baa3 with a stable outlook. Some economists are concerned that a power crisis will cost the country its last investment grade rating and lead to the outflow of billions of rands. According to SACCI, Moody's non-pronouncement of its latest ratings review of the economy provides a short-lived relief of the dreaded fear of a downgrade. If the announcement is left for after the elections, what should happen in the meantime? Eugene Visagie is portfolio specialist at Morningstar. Well, thank you very much for coming to our program, sir.
Good afternoon, Colin.
Well, what do you make out of the suspense, the volatility, or one should say that the suspense regarding what will happen before, during, and after the elections?
That goes hand in hand with this potential downgrade that we could face. But I think, again, just to touch on the downgrade that we did not get on Friday, Moody's understand that there are structural reforms being implemented in South Africa. But these are long-term to implement. It does not take a switch to quickly change something. They are aware of the issues that we have within Eskom. They are aware of the issues that we have within the SOEs. But they are also aware that there are very capable people in the government that are addressing these issues. And it takes time to actually change the course of where the country might go, and these things do not happen overnight.
There are dangers with the wait and see kind of scenario when it comes to the markets. How should investors react?
Unfortunately, that's very difficult to ascertain before the actual event, and especially with something like, if we just focus on the Moody's downgrade, the rise of passive funds and the rise of active funds, the rise of passive funds specifically, if they follow a specific mandate and they're only allowed to invest in investment grade, it's very difficult to say how it will play out. And it also depends on what's the risk appetite at that specific point. If we just rewind to last week Friday, we saw there was a 50% chance that we could get downgraded. Some of the market participants already started selling off some of our retailers and some of our banks. We did not get downgraded, and you saw how a lot of them actually started rebounding this year again. So it's very difficult to try and ascertain beforehand exactly to say what the actual effect will be. It really depends on where the global economy is standing at that point in time and what type of structural reforms have been implemented in the South African market.
What's going to happen now if there's a dim outlook of South Africa's growth forecast and being revised negatively? Do you think that this provides a harmonious investment climate?
Growth is not the only factor that they actually take into account. And it's difficult because, again, you're talking about a growth environment, but are we talking about our stock exchange? Are we talking about our economy? It's actually two very different things, especially if you look at the top 40. Those are all global businesses, and very little of their earnings are actually made within the South African border. So even with lower growth, you could still continue to see the JSE rising. But again, just to get back to, yes, a lower growth forecast, but that's not the only factor that's taken into account in these type of to make a decision if we should get downgraded or not.
So will this provide a problem and, you know, a hard direction to take in as far as portfolio or product positioning in the markets, where they wouldn't even know where to put them because of market volatility, or safe havens, or perhaps to take an aggressive stance?
I think it depends on the investment approach of the specific asset manager. At Morningstar, we are valuation biased. We definitely do not try and predict the event outcome, and we definitely do not try and predict how it will, what sort of effect it will have on a portfolio. But you're 100% correct. You do get more aggressive asset managers that might go and say, we feel very strongly that this will be the outcome, and position their portfolios. If they are correct, it could work very, very handsomely for investors. But if they are wrong, it could work very dearly against their clients.
I understand you're saying that you don't predict the outcome, but then what do you do with the situation being unpredictable? And not to say that you are pricing in that the ANC will win the elections after the 8th of May, but rather pricing in other factors such as exogenous issues that may happen regarding the Trump administration, trade warfare, as well as Brexit also impending?
So that's also a good question, because at the end of the day, you are looking for opportunities for your investors. And what do I mean with opportunities? Where the biggest upside could be, specifically in what is the type of risk that's taken into account. A great example, again, if we look at South African bonds, it has actually traded a junk type of status for the last couple of years. But that has created a very nice yield pickup for not only South African investors, but international investors too. And I think it's quite important to note almost 45% of our bond investments come from foreign investors. So at the end of the day, as investment managers, you need to go and see where's the best opportunity. Bonds at this point in time, a very nice pickup over and above inflation, and you need to analyze all the different asset classes similarly.
So what happens to the investor now? You play wait and see, but you don't predict the outcome, and the growth forecast has been reviewed. What happens?
I think that's actually very, very dangerous to wait and see. I think it's important that investors stay invested. At the end of the day, equities and bonds can grow a client's wealth at the end of the day. If you just sit in cash, you're just getting the interest rates of the South African market at the end of the day. But again, in South Africa, we are so negative at this point in time. And the general consensus and outlook, everyone is so negative. Just a little bit of good news can be very supportive of both equities and bonds. And that is exactly the type of pickup that clients want at the end of the day.
All right. Thank you very much for your investment insight.
Thank you, Colin.
All right. Eugene Visagie is portfolio specialist at Morningstar.